Welcome to Module 3, Financial Readiness for Operational. This is Lesson 3.4, covering Sales and Marketing Financial Controls. The Sales and Marketing Division is the massive engine responsible for generating the vast majority of a hotel's top-line revenue. Looking at this line graph, we observe a dangerous paradox. As the top-line sales volume curve accelerates sharply upward, the profit margin line drops in the opposite direction. Aggressively scaling volume can inversely cause overall profit to plummet. This gap represents three vectors of risk. First is non-compliance with negotiated contract terms. Second is severe revenue dilution caused by unmitigated discounting strategies. Third is the unchecked payout of unverified commissions to third parties. Without structural oversight, raw sales volume acts as a liability, exposing the property to revenue leakage and legal disputes, rather than generating true wealth. The Director of Finance, or DOF, serves as the essential counterweight and partner to the Sales and Marketing Division. They cannot rely on manual checks to manage this risk. The DOF must act as a systemic gatekeeper. Their primary method of control is establishing rigid standard operating procedures. To be effective, these SOPs must be deeply embedded into the hotel's digital infrastructure and daily workflows. This embedded architecture forces all sales activity through predefined checkpoints before any transaction is finalized. The ultimate mandate is clear. The drive for high sales volume must never come at the expense of profit integrity. We begin at the absolute start of the revenue lifecycle, the negotiation of group, corporate, and wholesale contracts. This diagram illustrates the first mandatory structural safeguard in the SOP architecture, the Contract Authorization Matrix. The core rule of this matrix strictly requires formal sign-off from both the legal and finance departments before any contract can be executed. During this review, finance vets specific financial variables, starting with the proposed payment schedules. They verify that cancellation penalties adequately protect the hotel's inventory, and that the negotiated commission rates remain financially viable. These individual contract terms must strictly comply with the property's broader daily rate strategy. Enforcing this multi-departmental matrix prevents unilateral sales decisions from creating binding, unprofitable legal liabilities. Immediately after a contract is signed, the hotel begins the intake of customer advance deposits and group prepayments. The most dangerous accounting error at this very stage is mistakenly logging these incoming funds prematurely as earned revenue. This diagram of a general ledger illustrates the absolute accounting rule. Advance deposits represents a strict financial liability to the hotel until the guest stay is actually rendered. The deposit and prepayment SOP is required to enforce this rule through rigorous logging and tracking procedures. Dictating the precise general ledger treatment is the only way to prevent the artificial inflation of current sales figures. The final verification step for this SOP is the mandatory weekly reconciliation of the internal deposit ledger against the physical bank balance. Rigorously categorizing unearned cash as a liability protects the hotel's long-term cash flow and operational solvency. Moving from cash handling into the hotel's digital data architecture, we look at the property management system and point-of-sale networks. Accurate daily rate, or ADR tracking, is the absolute cornerstone of all revenue analysis and forecasting. The foundational step for ADR configuration is establishing a finalized corporate-approved list of specific market segments. Looking at this modular PMS architecture diagram, we see the required primary segments: corporate negotiated, group, wholesale, and leisure. Accurate segmentation allows the Director of Finance to precisely track where every dollar originates, which is critical for competitive analysis. We evaluate this data by defining the standard calculation for net ADR. As seen in this visualization, the net ADR formula takes the gross revenue and actively strips away all non-room charges, resort fees, and third-party booking fees. The SOP strictly mandates how these deductions are recorded, either as a direct reduction of revenue or a sales expense, to maintain reporting standards. Calculating net ADR provides management with a sanitized apples-to-apples metric to objectively judge if a sales strategy is actually yielding profit. The final phase of the sales lifecycle addresses the payout of travel agent and group commissions after the guest stay. The commission payment SOP directly links the original negotiated contract terms to the accounts payable system. This integration dictates the exact timing and calculation basis for all external payouts. The Director of Finance must continuously run systems testing to verify the property management system's calculation accuracy. Looking at this workflow diagram, we see the critical sequence. The system must accurately calculate and accrue the commission liability before any payment is ever authorized. Automating and verifying commission accruals prevents post-stay margin erosion and closes the final gap in revenue leakage. Zooming out, we see these 4 SOPs: contracts, deposits, ADR tracking, and commissions, functioning as one interconnected, closed-loop financial system. This reinforces a fundamental lesson taught at the Europe Hotel School, London. The revenue generation process must be systematically governed by structural financial controls. When applied together, these controls guarantee that high sales volume does not compromise the profit margin or expose the property to legal risk. When the Director of Finance successfully executes their role as both partner and gatekeeper, controlled sales will consistently yield predictable, high-integrity profit.